The risk of loss in trading futures and options can be substantial. Therefore, only genuine risk funds should be used in such trading. Futures and options may not be a suitable investment for all individuals, and individuals should carefully consider their financial condition in deciding whether to trade. Option traders should be aware that the exercise of a long option will result in a futures position. Information herein has been obtained and prepared from sources believed to be reliable. Comments contained in these materials are not intended to be solicitation to buy or sell any of the commodities mentioned. Past performance is not indicative of any future performance. Opinions expressed here are the opinions of the author only, and not the opinion of any firm the author may be affiliated or associated with.
All right, welcome back to Commodity Classics. I'm Michael Yorba, your host. Thanks for joining us. We've got Tony Chernowski here this segment. We're going to bring him back in right away. We're going to go right to the shout box. We've got a good question that's been standing by from the last segment. Tony, thanks for coming back.
Yes, sir.
All right, let's start off with Greg's question in the shout box from last segment. So is the bull market over in gold?
The answer is very likely yes. How's that for an answer?
Okay.
And the reason why is that all commodities work in roughly a 9 to 10 year cycle. Mm-hmm. And so the cycle bottom was in June of 2001, if I'm not mistaken. Mm-hmm. So that is quite a long period of time of being in an uptrend. Very, very long. We're very, what we call right translated, very fat tail there. Mm-hmm. What we have now is we've got basically about 2, possibly 3 years of decline ahead of us if the cycle is going to maintain its 9 to 10 year length of time. So yeah, we're in for quite a slide here if that's the case. So we're not, you know, this is one of those things that if you were to put a gun on my head, I'd say, yeah, I think it's over, but you know, let's wait and see. I think we've got to break some more resistances here before we really call it a done deal.
Some more support levels, you mean?
Some more support, excuse me, yeah.
Sure. Now, real quick, you said in the last segment that you're looking for a July-August low somewhere around 650 based on what you've got to work with right now, right?
Right, that's right.
Let me throw my hat in the ring with you.
Okay.
I was looking at, now, ladies and gentlemen, Tony doesn't use astrology to forecast the market. I like to use it because it seems to be something that I found something I can put my hat on to coin a phrase. I'm going to throw a date out there for you, Tony, that I found several aspects lining up, and I didn't really look at it until you mentioned it.
Okay.
Turns out July 14th.
July 14th. Okay. I'm in.
Okay, well, let's see if it happens. All right, let's go to the stock market, unless you would more conversation about
well,
the
real
gold.
Quickly to answer the question, how far could this go down? And by the way, I didn't. I looked at my supports on my model, and believe it or not, the supports come in at about 725 to 730.
Okay.
So this could be a very ugly drop if that's what the support's going to, you know, finally hold up the bottom of this decline. So I'm not entirely sure that that's going to work, but excuse me, I have no support level down to that level. So
okay, so
here we go.
725, 730 first, then
right.
Your 650 target looking for July, August.
That's right.
Okay, how are you playing, before we get to the stock market, God bless you, how are you playing this? What instruments are you using to take advantage of the trades? I'm
using an inverse gold ETF called DZZ. It's a double short ETF. So it's a handful to work with, believe me. You know, when it goes, it really goes. But I found that that's been very effective. Okay, and is there a minimum that you need to come up with to take advantage of it? I've never traded it. That's what I'm asking. No, the ETFs have. You have to be able to buy whole shares. That's the only situation with ETFs. So,
a share,
for example, right now the shares are going for $29.75 a share, roughly, and so we have a. You know, you could buy 3 shares for less than $100. I mean, that's how ridiculous it could be. Of course, you've got your trading costs and so on, so I'm sure you don't want to buy, you know, that many or that few. But, yeah, there's really no limit, no lower limit on that.
Does it move proportional to the price of gold?
Mike, the answer is, in general, yes. it moves proportionally inverse to the price of gold. So gold goes down, DZZ goes up.
Right.
However, you have to remember that this is an exchange-traded fund, and this is not a true index of any sort. It's created by Wall Street, and it's maintained by them. So what you find is occasionally there are anomalies where you would expect DZZ to go up or down opposite the market, and it doesn't, frankly, always respond. Now, sooner or later, they have to maintain some type of the bid-ask spread and some a nominal relationship to the price of gold. So sooner or later, it does catch up. But there are periods of time where you're going to see. It's possible, for example, Wall Street sweeping the shorts out, where DZZ might zig instead of zag, and you get swept out on the wrong motion, and find out when you come back an hour later that you would have been better off holding it. Okay. So I see those types of activities in the market, and frankly, it's not for the faint of heart.
Okay, let me get this straight. If we've got a 23% move from, say, breaking the low, 846 to 650 in the gold market, then am I correct in assuming that we should think that we'd be getting somewhere around a 23%?
No, sir. No, sir. It's even more than that.
Times 2, because you said it's times 2?
Right.
So 46%.
But remember, what you're doing is you're buying at 23% lower. You're buying at 77 and selling at 100, so to speak. So what you've done is when you've gone short or when you're buying an inverse fund, you are selling first and then buying back later. So the effect is that you've bought at 77 and you've sold at 100. That is about a 29.8% return. Times 2, so we're almost talking about a 60% return on that type of drop.
Oh, okay. So you can actually make more money buying this fund than you can shorting gold.
That's possible. The futures market is highly leveraged, so you could make more there by selling a contract, but you also have a lot more liability there too.
Assuming you've got apples to apples on leverage.
Right. That's right.
That's interesting. All right, let's get a few questions in the shout box before we turn pages to the stock market.
Sure.
Let's see here. Dallas 41. Should we assume platinum will follow gold down?
You know what I've been observing to answer that question is that one by one, all of the ETFs in the commodities markets have been taken out. In other words, they've topped or are in the process of topping and going down. What I think is happening here is not so much, a lot of people are talking about hyperinflation and stagflation and the price of gold going to 2,000 and so on. Please understand that fundamentally I would agree with that, and I believe that these things can happen down the road. However, right now, number one, we're at a cyclical high, and unless the cycle breaks, we are probably going to see that decline that I was talking about for the next 2 or 3 years. The second thing is that I believe that we're in a bit of a liquidity crunch. And so at some point, cash or the dollar is going to be much more valuable to people than owning a commodity or a stock.
I'm so happy you said that. You got to watch this last segment we've got on the show. It addresses that issue to the T. But anyway, go. Really, it does. I'm glad that you said that because it's hard to take that thought and really formalize it in a fashion that people can understand. And not that I'm any great economist or trader, but I agree with you.
Yeah, let's just harken back. Even just a year ago, I often heard the phrase "cash is trash," and to the extent that the dollar was declining and cash could, bonds could earn so little interest and so on, that was literally true. You really look down on cash as being an inferior asset to own. At the same time, when we have a period such as this where the cycles are down and there really is no other haven, then cash is not trash. Cash becomes king at this point, and I think that we're seeing that turn. Now, there's a lot of people that will disagree with me, so I'm just going to respectfully say that this is my opinion, and I'm basing this on my knowledge of the cycles, and we don't have total confirmation that they're heading there yet, but where it appears that we may be going now.
Okay. One last question in the shout box, and then let's get to this S&P because it's very important that we bring this up. Greg wants to know, but does the commodity cycle top, what about the commodity cycle top that's been projected for 2010?
I'm not sure that I can agree with that.
Okay.
And that's somebody else's interpretation of where the commodity cycle is. I believe that we have a 10-year cycle, and it's pretty clear that the bottom was in 2001. So we've got some work to do to go back down to a bottom. Whether it's higher or lower than the 2001 bottom is yet to be determined. I just can't answer that.
Nice way to say that. Okay, we've got about 2 minutes left. Let's get this S&P 500 out. And all right, there we go. It's up, Tony. What do we got?
Okay, very good. We have we're working on the neckline on the S&P right now at about 1370. And we've rested at that point just a couple of days ago. I believe Friday we came down to that, or maybe as late as Tuesday of this week. And we've rallied it back up to about 1,400 or so today. That was a nice little rally, but the fact is that it has all the appearances of failing at this point. Mm-hmm. So the thing to watch out for, this would also be an excellent sell signal, by the way, is a drop below 1370. It not only gives us a sell signal on the S&P, but it also invokes the head and shoulders pattern there with a target of about 1165. So I had the darker line drawn there, and it for those that may not be able to read it, it says head and shoulders target across the bottom of that lower line. So
what's that price where the target is?
1165.
Okay, it's
the target. Now again, that's a soft target. It could go lower than that. But
well, we're real close to that 1370 because S&P's. I have low today at 1386.
That's right. That's right. We could get very close to. In fact, I would suspect that we could see a sell signal as early as tomorrow on the S&P, and a potential very quick drop down to 1165.
Okay.
That's all she wrote, Mike. I mean, you know. Maybe we're surprising a few people, but I believe that we're done going up here at this point, and we need to see the next leg of this bear market unfold.
Okay. Let's come on back to Tony. Tony, you've got Ted and Greg and Toreador with questions that have come in at the end of our segment. Could you do me a favor, go on into the shout box and answer their questions for you? Because Ted, let's see, Greg wants to know about a platinum ETF, Toreador, short-term Fibonacci retracements on the S&P 500, and we don't have time on the segment to talk about it, but could you, and ladies and gentlemen, Toreador and Greg, he's got a social network page. Go ahead and click on it real quick, send him an email and talk to him, and, you know, Tony, if you got time to get in there, go ahead.
I'll be happy to do that. I've got a little bit of time here right after the program.
Okay, sounds good. Thanks very much, Tony.
Thank you. Enjoy your afternoon.
I will, Tony. We'll talk to you later.
Thanks. Bye.
Okay. All right. That was Tony Chernowski, the Practical Investor. Great guy. You saw some really good trades out of him. I'm Michael Yorba, your host. Up next, Tim Bost. We'll be right back.